Good evening, very good evening, everyone. I hope you guys are doing good. So now we can we're good to go. Good evening, everyone. So we can see many guys are still online right now. Shrisha, Hardik, Kadambari, Sri Manohar, Shankaran, Mercy, Sahil. Okay, lot many guys are there online. Uh, just to recap, we have started with the topic of return the last year, right? And now we'll be taking this topic further with some concepts pending and also some amount of questions from the module will be uh, okay. So let's quickly recap the ratios that we have done. First, we started with the current ratio. Current ratio was basically current assets upon current liabilities. Even better version of current ratio was liquid ratio or the quick ratio or the acid test ratio, or you can also say the cash ratio. These were better versions because they were giving some sort of additional surety of our ability to pay our current liabilities. Uh, then the difference between current ratio and the difference between basically current ratio and other ratios was we were filtering out current assets. Those assets were not good enough to be paid. They were getting filtered. And then definitely we went ahead with the basic defense interval ratio, which was telling us how many days of cash balance we have. Uh, Post that, we looked into the proprietary ratio, debt ratio, which we were using to calculate the long-term stability of a company. We also saw capital gearing. Capital gearing was basically ratio of fixed cost funds upon non-fixed cost funds, which was telling us to what level of risk the company is operating as of now. Uh, then post that, we also went ahead with some of the return ratios, which were return on equity, return on capital employed. We also saw how to measure the ability to pay the dues on time. So for that, we had various coverage ratios, which included interest coverage ratio, preference dividend coverage ratio, fixed charges coverage ratio, debt service coverage ratio. Uh, then we went ahead with the activity ratio or the efficiency ratios, which we were talking of in a sense about the asset turnover, fixed asset turnover, or capital turnover, current asset turnover, working capital turnover, all of those aspects. And we saw inventory turnover, which was telling us how many times in a year we were actually selling our one lot of inventory. And same goes with the receivable turnover and payables turnover. Then profitability ratios, we had certain ratios which are based on sales. That is, all those measures are basically fixed upon net sales into 100. That X was different values, right? We had certain profitability ratios which were based on return on investment. Uh, we had certain ratios which were based on what return we are providing to the owners and also certain market ratios. Okay. We had gross profit ratio, net profit ratio, operating profit ratio, expense ratio, operating expense ratio. Then, how do we measure the given percentage on return on investment? Okay. Now, return on investment, we can compute whether on assets. So it will be like EBIT 1 minus T upon assets. On capital employed, it is EBIT upon average capital employed. Uh, then on equity funds, you will look at net profit for equity shareholders divided by equity shareholders funds. Similarly, we had market ratios, which were talking about EPS, dividend per share, dividend payout, retention ratio, P ratio, right? So those all aspects we had covered till now. So we have a few more ratios to be dealt as of now. So let's have a look at those ratios before we go to the questions. Okay. Um, the ratios which we are yet to cover. And yeah, so we had earnings yield, dividend yield is what we have done, correct? P ratio is also done. Now we have to look at a ratio called as market value to book value ratio, then Q ratio, and then the DuPont chart. Okay, so let's begin with the next ratio, which is talking about the market to book ratio. Market value to book value ratio. See, market value to book value ratio. Now, market value to book value ratio, as the name says, it is market price per share upon book value per share. So market value to book value ratio is basically market price per share upon book value per share. Now, how do we get this book value per share numbers? Right, market price is what we observe in the market, right? Now, how do we get this book value per share? What do you mean by book value per share? So let me just take an example uh, as a balance sheet. Take a clue from the balance sheet. Let's say a company has got assets, and I'm talking of the real assets. We are not talking of anything in the sense of fictitious assets as such. So let's say the company has got certain PP, it has certain intangible assets, it has got some current assets, right? Uh, and obviously, let's say we have got some current liabilities. So PP, property, plant, and equipment. What we can see is, let's say PP company has got PP of 10 lakh. It has got an intangible asset of 3 lakhs, and various current assets that the company has got is having a value of, let's say, 8 lakhs. Now, current assets, intangible assets, and PP, that gives us a total assets value. Total assets value works out to be 21 lakhs. And suppose the company has got a current liability or a creditor or anything payable of 4 lakhs. Now, of course, the company will be having some sort of equity share capital, some reserves, and maybe some sort of debentures. So let's say equity share capital is 5 lakh. Okay. Then we have the debenture value of let's say 2 lakh. And then the balance sheet figure, you can see the reserve that works out to be 10 lakhs. Reserves of 10 lakh. So now, and of course, it should get tallied. I think it is getting tallied on this 21 lakhs. So 4 plus 2, 6. Yeah, 21 lakhs. This is a summarized balance sheet of a company. Now, if I want to say what is the book value of the share, book value per share is basically value of the company's shares as per the assets and liabilities that it has got. Book value per share is simply net assets Okay, let me just take it. Value per share is net assets minus outside liabilities upon number of equity shares. So like for example, in this case, net assets is basically 21 lakh minus 4 lakh, that is the net assets, minus outside liabilities is 2 lakh, divided by number of equity shares. Let us say these equity shares have got a face value of 10 rupees. So that translates to 50,000. So the book value per share, we can calculate it as 21 minus 4 lakh, which is 17 minus 2, 15, 15 lakh divided by 50,000. That is rupees 30. Book value per share is rupees 30. Okay. Outside liabilities is basically what you have to pay to the outsiders. Basically bankers or the debenture holders, all those aspects come over, right? So as per the books of accounts, value of each share is 30. You can actually compute this book value per share by liabilities approach also, which you will say as equity share capital plus reserves divided by number of equity shares. You can also do this. That also is going to be giving you the same 15 lakh divided by 50,000, which is rupees 15 lakh divided by 50,000, which is rupees 30. So equity share capital plus reserves divided by number of equity shares. That gives us a book value as rupees 30. It means based on the value of the assets in the books of accounts of the company, each share is worth rupees 30. Each share is worth rupees 30. Now we got the denominator. Now market price per share. So let us say book value per share is 30. In the market, the share is trading at 50. So here we get this answer as 1.7. Get the answer as 1.67. So it means the market price is 1.67 times of the book value, right? Outside liability is 2 lakh, debenture of 2 lakh. Outside liability is debentures. Remember, shareholders are your own people. You are not going to treat them as outsiders. Debenture holders are your outsiders because you need to pay them. Okay. Right? So that's where we say that no, debenture 2 lakh is the outside liability. 6 lakh current liability and debentures. Yeah, total say four. This is 4 lakh and 2 lakh. The total assets was 21. 21 minus 4 is your net current net assets. Minus 2 lakhs is your the outside liability. So book value per share comes out to be rupees 30. Now market value to book value share we have 1.67. It means market price of the share is 1.67 times. Market value of the share is 1.67 times of the shares of the book value. So does it mean that the company is really overvalued or undervalued? Does it mean company is overvalued or company undervalued? Uh, you cannot say either because book value of a company is not its real value. What would be the real value of the company is actually it depends on company's earning capability, right? Depends on company's earning capability. So price of a share, value of a share, it cannot be said to be equal to its book value. In certain cases, you will say value of the share should be ideally equal to book value, but not in every case. Now, which are those cases where you can say that book value per share should be same as its intrinsic value? You can say in case of banking stocks, whatever is the value of assets they have got in book value terms, that you can say it is replica of the intrinsic value. But as per books of accounts, whatever value you have, that need not be the fair value of the company. For example, if you are recording PP value as 10 lakh, this PP is after providing for depreciation, right? But are you sure that the rate of depreciation which you have provided is correct? No. Even in case of current assets, are you sure that your assets are going to be, stock is going to be sold at that price? Intangible asset is going to fetch you this value? No. So you cannot actually determine what is the book value per share, what is the intrinsic value based on the book value. Yes, this number, market price, market value to book value ratio, if it is higher than one, market value to book value ratio, if it is higher than one, it means the market price of the share is more than the book value. Means the market value of the share is more than the book value. Okay. Now, suppose if a company's balance sheet comprise of uh, preference shares also. So even preference shares needs to be removed because preference shares are no less than your debenture holders. You need to pay them a fixed amount of returns. For that reason, even the preference shares are going to be removed. Preference shares are supposed to be removed from the balance sheet because, I mean, not removed from the balance sheet, but should be removed when we are computing the book value first. But they are not your own, they are not your equity shareholders, right? They're not something where there is no obligation on you to pay back. In case of equity shares, you don't have any obligation to pay back. Okay, so that's your book value to market value ratio. The interpretation is the company valued higher than its book value or lower? And you generally compare companies in the same industry. Generally compare companies in the same industry. So let's say in the industry which you have, the type of company which you have, let's say industry book value to market value ratio is 1.5 times. And if you have let's say your company book value to market value ratio, your company book value to market value, if it is having let's say two times, what can you say about this company? This company, is this company overvalued or undervalued? Your company value to market value ratio is two times, whereas all other companies are having a market value of 1.5. What can you say about the respective company? Is it overvalued or undervalued? What will be your conclusion? Yeah. What will be your conclusion? Is it overvalued or undervalued? Definitely, it's a case of overvaluation because when all other companies in the industry are having this 1.5 times, it means their market price of share is 1.5 times of its book value. How can your company be twice of, right? So you need to again do some sort of research as to identify why people are ready to pay such a heavy premium for the price of these shares. Is it really a company which is very strong or very good in terms of revenue growth or whatever? If it is, then you can say okay. Then you need to do further research whether this is sustainable or not. But from a very first instance, we can say this company is overvalued. Okay. How is the industry value computed? This is the average of all the companies in the same industry. Like for example, if I tell you auto industry, in auto industry you have Mahindra and Mahindra, you have Tata, you have Maruti, right? You have maybe Hyundai, right? Uh, so all these companies will be having some value. So you take an average of all such companies and sell it. Okay, so that's our ratio of market value to book value ratio, which is indication of whether a particular stock is overvalued or undervalued as compared to the industry. Okay. Now, let's look at a similar ratio, which is based on some similar concept, which is called as a Q ratio. Q ratio. Now, the inventor or the researcher who found this ratio named it as Q. So there's no logic as such. Why? Now, Q ratio is basically market value of the company as a whole, the value of entire company divided by replacement value of or replacement cost of asset. Replacement cost of asset. So let's say market price of a share, market price of share is rupees 25. Number of equity shares is suppose 10,000. So market value is 25 into 10,000, which is 2 lakh 50,000. Market value is 2 lakh 50,000. Market price is 25. Number of equity shares is 10,000. And market value is 2 lakh 50,000, right? Value of the company is 2 lakh 50,000. And let's say the company has got some assets. And if you are going to replace those assets today, I'm not talking of the book value of the asset. We are talking of replacement value. Replacement value is if we are going to replace that asset today with similar assets from the market, okay, that may cost us 2 lakh rupees. So now the ratio is basically 2 lakh 50,000. This will be 2 lakh 50,000 divided by 2 lakh, which is 1.25. Again, this Q ratio is used for determining whether our particular stock is overvalued or undervalued as compared to the industry. Because here we are doing a better thing. We are not considering the book value. We are considering the replacement cost. Replacement cost means if I'm going to replace this cost if the company is going to replace all its assets with similar assets by buying it new from the market, what will be the cost of the same? Okay, is it clear? So both the ratios, Q ratio and market value to book value ratio, it's just the same. Okay. Srini was asking market value of company, so we need to add the market value of debt. Correct. When you say market value of the company, it means market value of, when we say this, we're talking of market value of company, we're going to consider market value of equity plus market value of debt. Market value of equity and market value of debt. Okay. What is intrinsic value as per Q? Intrinsic value, there's no intrinsic value as such. It is the replacement cost of asset. What is the cost that you need to pay? Depreciation, we are not considering over here because we are talking of what I should pay to get this from the market as of now. So there is a price which you need to pay to get the assets. It has nothing to do with your depreciation or anything. Price which you need to pay to get the asset. Okay, so these two are the ratios that we had. Now let me just wait for a couple of minutes if you guys have any queries. Otherwise, we are good to go for the next concept or the last concept in this chapter, which is DuPont analysis. And post that, we'll be doing questions from the module. Pawan is asking, is book value per share Q ratio? Book value per share is a number, Pawan. It's just the value of one share in terms of books. And Q ratio is the ratio between the market value and the replacement cost of asset. Okay. Anyone else? I think what's the intrinsic value? What is fully hedged bonds? Fully hedged bond is those bonds which are protected from any inflation or protected from any fall in the interest rates. Why is Q ratio is again, as I say, Q ratio is a measure to check whether whether the stock is overvalued or undervalued as compared to the industry players or the other industry companies. Q ratio is used to determine the replacement cost of asset over the market value of the company. Why do we need to calculate? Q ratio, as I said, just to measure the whether a particular stock is overvalued or undervalued. Market value of debt is the market value of the debentures that the company has got. Okay, it's fine. Now let us go ahead with market ratios. Yeah. Now it's time for the DuPont analysis. DuPont chart. If I tell you there are two companies, A and B, both of them are providing a return on equity. Both of them are providing a return on equity of 20%. DuPont analysis, both the parties are providing a return on equity of 20%. Uh, if I ask you what are the strengths and weaknesses, what are the advantages, disadvantages of these two companies, or in which areas company is doing good or in which areas company is doing bad, we cannot actually identify from these numbers. We need to go deep down into these numbers, into return on equity, so as to arrive at some numbers from which we can sort of uh, analysis as to where the company may go wrong. Then therefore, there was a French company called as DuPont, which actually performed or represented its financial statements in a typical pattern, which we call it as DuPont chart. So it actually distributes the return on equity into three factors. It distributes the return on equity into three factors. So let me just tell you what are those three factors to which this company actually distributes the return on equity number as. So if we have return on equity as, let's say, profit after tax upon equity shareholders funds. Return on equity, if it is profit after tax upon equity shareholders funds, you can distribute this profit after tax or equity share into three categories. If the company is getting good return on equity, we need to measure it from three different angles. The first angle is profitability. Second angle is turnover. Third angle is gearing or equity multiplier. Gearing or equity multiplier. Okay. So pat upon equity shareholders. If you're saying that a company has got a return on equity a certain number, what are the classifications of that? The first criteria, as I said, it is profitability. So profitability is measured by profit after tax upon sales. How actively you are doing your business. For that, we use the turnover ratios. So turnover ratios will be calculated using simple formula of sales upon total assets, or what we say is we are using the asset turnover ratio. And gearing is considered as assets on equity shareholders funds. If you look at over here, you are just multiplying these three and you're getting the PAT. Your return on equity is a result of your company's performance in these three areas. One is the profitability, second is the turnover, and third is the gearing. So we are going to look into, let's say, this particular portion. The first portion says, what percentage of sales is profit? Second aspect, it tells us how many times of asset is sales. How many times of assets is sales? Third is, what is the ratio of asset to equity shareholders funds? Now, let us say, let's look at an example. There is a company, there is a company which has got a profitability margin or PAT of, let's say, 10%. Its turnover is two times because sales upon asset is, let's say, two times. And let's say gearing is one, or I can say it is fully covered by equity shares itself. We say equity shareholders as assets upon equity shareholders funds. So that is working out to be 1 week, one time. So whatever is your assets, it's fully funded by equity shareholders funds. So profitability 10%, turnover two times, and gearing is one time. So if you just multiply all of them together, we get a return on equity of 20%. Is what we have said earlier, right? Now we have a second company which has got a PAT margin of 5%. It means the company is earning just 5% profit on its sales. Turnover, it is three times because the company is maybe maintaining lesser amount of assets for the same amount of sales, or maybe uh, at a lower assets you are having a better amount of sales, or either of. But the turnover is, let's say, three times. And gearing over here is 1.33. If I say gearing over is 1.33, it means the assets which you have, that is 1.33 times of equity shareholders funds. The assets which you have, those are 1.33 times of equity shareholders funds. It means 0.33 part of your assets, or I can say for every 1 rupee of equity shareholders, while you have 1.33. So 0.33 of your assets is funded by borrowings. And if you multiply these three, again you get 20% return on equity. So there are companies which are providing you the same 20% return on equity. We have two companies which are providing the same amount of same percentage of 20% return on equity. But there are certain strong points and weak points over here. If you compare both the companies, and I want you to comment on the first company, tell me in which area the company is going strong. The company is actually strong in the profitability part, whereas it is weak in the turnover and capital gearing. Whereas if you look at the second company, it is weak in its margin, but it is able to uh, maximize the return for its shareholders by keeping lesser assets and maybe having a higher turnover, which is three times of the assets, and gearing or equity multiplier is 1. Okay. So here we have all the cases, both the companies that you observe. That first case, profitability, the company is going strong, whereas second company is strong in turnover and right. So the point is, even both the companies are having a gearing of the return on equity of 20%. If the second company is able to overcome its weakness of selling at lower profit margin, then this can actually perform better than the first company. This can actually perform better than the first company because this will be able to generate a higher rate of. So maybe if instead of 5%, if it just becomes 6, there'll be 6 into 3 into 1.33, which will be like this will be 18 into 1.33, that will work out to be 24%. So just 1% increase in your profitability will lead to a 4% increase in your return on equity because your other factors are strong. right? Similarly, if we are to advise the first company, we would say, do one thing, try to make more and more quantity of sales, and try to have a gearing some sort of thing, or reduce the equity shareholders fund and try to bring more borrowed funds at a cheaper rate, which will return a higher percentage to the equity shareholders. So DuPont is basically classifying your returns or distributing your returns into multiple areas, wherein you check which are the areas where we are going strong or where we are going weak. Okay, is that clear, guys? The DuPont chart or the DuPont analysis. Okay, fine, guys. So are we good with this? Market value, we can say enterprise value. Yes, Universal, you can say it to be equal to enterprise value. Does it include current liabilities in Q ratio? No, not current liabilities. We're talking of assets. Yeah, I mean, you take it to net assets consideration. Okay, so DuPont chart, we have three parameters on which the return on equity depends. DuPont is the distribution of your return on equity into further categorization. Okay, everyone. Fine. So let us do one thing. We'll take up questions from module today for solving. Also, I will give you an assignment to be solved after today's class. Two questions I'll be giving. I'll be uploading it on the portal, on the ICAI portal, which you have to do it as homework, as an assignment. Are we good? Okay. So I'll share the viewpoint thing, not viewpoint, but the questions, assignment questions. Right now, we'll do questions on module, certain questions from the module itself. So let me just get the module over here. Exima, this is not the last for ratio. We'll have one more session on for revision of ratio and one more topic. So we'll discuss the solution for ratio in that place. But yeah, as far as concepts are concerned, this is going to be the last one. Just bring the module for your reference. Just for the screen. then we do that. Nancy is asking, it is difficult to remember. You will have to remember the formula logically, Nancy. Remember the formula, you will not be able to apply them. So essentially, we'll have to remember the formula. Now I think it should be visible to you guys. I hope the screen should be visible to you right now. Okay, fine. So let us take certain questions from the practical problems. Let's take few questions from the practical problems. We'll be solving few questions, and the other questions I will require you to solve it later at your own pace at home. And then if there are any issues, you can definitely highlight the same in the revision class. Question which we are going to look right now is, uh, let's do question number 3 right now. Is question number 3 from the module. Question number 3 on page number 3.67. Page number 3.67. Okay. Question 3. Let's have a look at it, guys. Let's solve it together. So looking at question number 3. The following accounting information and financial ratios of PQR Limited relates to the year ended 31st March 2023. We have certain information for the year ended 31st March 2023. Gross profit is 15% of sales. Net profit is given as 8% of sales. Raw materials are 20% of works cost. Direct wages are 10% of works cost. Stock of raw material is 3 months usage. Stock of finished goods is 6% of the works cost. And debt collection period is 60 days. This is basically debtors collection period. Financial ratios. We have financial ratios as fixed asset to sales, fixed asset to current assets, current ratio, long-term loan to current liability, share capital to reserves and surplus. Okay, so these are some of the ratios. Now, if value of fixed assets amounted to 26 lakhs, so one important figure that the question has given us is uh, the value of fixed assets. We have fixed assets to be 6 lakh. Prepare a summarized profit and loss account of the company for the year ended 31st March 2020 and also the balance sheet as on 31st March 2023. So we need to prepare the balance sheet as well as P&L, right? Balance sheet and P&L guys. So fixed assets 26 lakhs. Now let's look at what all ratios are given. First up, gross profit information is given. Them are a percentage of sales basically. So using fixed cost, can I get the value of sales? Yes, sir. You can get the value of sales by simply looking at fixed asset to sales ratio. Now, fixed asset to sales ratio is 1:3. So we'll use sales fixed asset upon sales is 1/3. And we know the fixed assets are amounting to 26 lakh. 26 lakh upon a sales value is 1/3. Therefore, sales will be 26 lakh. Sales is 26 lakh into 3. 26 lakh into 3, right? Voice lag. 78 lakh. Okay, there's a network issue. Voice is also low आ रहा है एक सेकंड नेटवर्क चेक कर ठीक है. Now it should be good enough. Is it proper now? Is it interesting? Okay. So sales is 78 lakh, guys. So sales was 78 lakh, which is simply 26 lakh into 3. We have got the sales value. Now let's look at some more ratios which will be useful for solving this. Uh, since we got the sales figure, now we can easily get the gross profit, net profit, raw material consumed. We can get it as a percentage of works cost. Uh, and then if you look at some more other ratios, there's nothing else mentioned because all of them are like fixed asset to current ratio. We can get that easily. Now, right now, we are assuming that all the sales are now going to be on credit. So let us compute the gross profit and net profit from here. So gross profit ratio that they have given us. Gross profit is basically 15% of sales. Gross profit is 15% of sales. So accordingly, you can say it is 15 upon 100 into sales value of 78 lakhs. Right. So 15 upon 100 into 78 lakhs will give us 78 into 10, which is 11 lakh. 70,000 is the gross profit. Okay. We got 11 lakh 70,000 to be gross profit. So obviously our works cost is going to be sales less gross profit. Sales less gross profit, which is 78 lakh minus gross profit of 11 lakh 70,000. 78 lakh minus 11 lakh 70,000. This is 66 lakh 30,000. Works cost is 66 lakh 30,000. Uh, then the question has also given us the net profit figure to be 8%. So if your net profit is basically 8%, it means the PNL in the PNL statement will find that there would be some selling and distribution and other such expenses, admin and selling and distribution expense. So let us compute the net profit also. Net profit is 8% of sales. So it is 8 upon 100 into 78 lakh. So net profit works out to be 78 lakh into 8%, which is 6 lakh 24,000 is the net profit. Okay. So the difference between the gross profit and net profit should be ideally the admin selling expenses. So if we say gross profit minus net profit, gross profit minus net profit should be administrative and selling expenses. So our gross profit was 11 lakh 70,000 minus 6 lakh 24,000 is your admin and selling expenses. 11 lakh 70,000 minus and the admin and selling expense 5 lakh 46,000. Let's highlight the items that we have got. One is the works cost, another is the net profit. Then we have got the gross profit figure to be this. Then we have got sales to be this. Okay. So P&L items, more or less, we are pretty clear as of now. So if you look at the P&L format, you can actually fill up the profit and loss account fully over here right now. Let's say profit and loss account. So we have the sales of 78 lakhs, right? And then we have the gross profit computed. Gross profit is computed as 11 lakh 70,000. Gross profit is computed as 11 lakh 70,000. We bring this gross profit down, and then we have selling and distribution. Selling and distribution is we have computed it as 5 lakh 46,000, or selling and admin expenses, admin and selling expenses. We've got admin and selling expense to be 5 lakh 46,000. And then we get the net profit figure. Net profit is 6 lakh 24,000. Six lakh 24,000. By sales, we have 78 lakhs. Now, if you look at the other items, raw material consumed, direct wages, stock of raw material, stock of finished goods, all these numbers are given. Since we are given the raw material consumed figure, let us compute that raw material consumption first. Raw material consumption is simply 20% of the works cost. 20% of works cost. Works cost is 66 lakh 30,000. So raw material consumption figure will calculate as lakh 30,000 into 20%. 13 lakh 26,000 is the raw material consumption. So in the P&L, we have raw material consumption as 13 lakh 26. Okay. Then raw material consumption is 13 lakh 26,000. Then we have next item is next we have just the this figure. Any other labor cost is given? Direct wages, yeah. Direct wages is 10% of works cost. Let us compute that. Direct wages is 10% of the works cost. Is 6 lakh 30,000 into 10%, which is 6 lakh 63,000. So here we have raw material consumption 13 lakh 26,000 and direct wages is 6 lakh 63,000. Still, you will find there is some gap over here which has not been taken into consideration. Now, that gap will be definitely some sort of overheads. or production overheads or works overheads. We'll say this as production overheads. And this is going to be a balancing figure. Okay. So what is that balancing figure working out to be? 11 lakh 70 minus 78 minus 11 lakh minus 663 minus 1326. That is 14 lakh 14 lakhs 46 lakh 41. So here we have the projected P&L available for us. We have the P&L computed. This P&L clear to everyone? We are yet to complete the balance sheet. For balance sheet, we'll have to use a different set of ratios. Okay, so stock of raw materials, stock of finished goods, this we are going to use for the purpose of getting the balance sheet figures. This balance sheet is even debtors is going to be computed using balance sheet figure, and then we have these numbers. So let us go ahead with the next step of preparing the balance sheet. So we have fixed asset to sales. From that, we got the value of sales, and fixed assets we already know. Let me just prepare the balance sheet and then maybe carry out the working notes as to whatever is required. First, we'll talk of fixed assets. Okay. Fixed assets is given in the question, right? 26 lakh, that's given. Then we will be having some set of current assets. Now, what all current assets are we really going to have? We just need to look at the balance sheet. In current assets, we'll have stock of raw materials, stock of finished goods. We'll have debtors, and there's some current ratios. Obviously, the company needs to have some amount of cash balances. So, in current assets, you will have stock of raw material. Then we'll have stock of finished goods. We'll have the amount of receivables, and then we'll also have cash and bank balance. On the liability side, of course, the company should be having some amount of share capital. The company will definitely have some amount of reserves. Then any other information we have, yes, long-term loan to current liability. So we'll have long-term loan and current liability. Long-term loan and current liability. Okay. So let's look at the numbers. First of all, stock of raw material, it is going to be 3 months usage, and stock of finished goods is 6% of works cost. Let us get the stock of raw material. Stock of raw material. They are saying it is 3 months usage. So this will be simply 3 by 12 into raw material consumed, right? Raw material used or raw material consumed. That is 3 by 12 into raw material consumption is what we have computed in the P&L, 13 lakh 26,000. 13 lakh 26,000. Stock of raw material will work out to be 13 lakh 26,000 into 3 divided by 12, 3 lakh 31 500. Then stock of raw material, we got the figure as 3 lakh 31 500. Stock of finished goods, they have given us to be 6% of the works cost. Stock of finished goods, is 6% of works cost. That's 6% of works cost. It is 6 upon 100 into works cost is something which we have computed. Total works cost was 66 lakh 30,000. Works cost is a multiplied by 66 lakh 30,000. Stock of finished goods is 66 lakh 30,000 into 3 lakh 97 800 is the value of stock of finished goods. We write down the stock of finished goods as 3 lakh 97 800. Then receivables. Coming to the receivables part, let's look at what's there in the question. Debtors collection period is 60 days. So all sales are on credit. Debtors collection period is 60 days. So we can say the value of debtors average, or you can say just the closing debtors or receivables will be sales into 3 days. So there's a question specified as to we need to take some 60 days or something like that. No, nothing has been specified. So we can say sales into 60 divided by 365. What is the sales value? Sales is 60 lakh. So sales value we have got it as 78 lakh. 78 lakh into 60 by 360. 78 lakh into 60 by 365. The value of debtors or receivables will be 78 lakh into 60 divided by 365, which is 12 lakh 82 192. The receivables value is 12 lakh 82 192. Cash balance, nothing has been specified, so we'll fill it up later on. Let's take up the other aspects. Other aspects is share capital to reserves and surplus is the ratio. Then we have fixed asset to sales that is already utilized. Fixed assets to current assets is 13:11. Now this is a big breakthrough, since fixed asset to current asset means fixed asset upon current assets. Fixed asset to current assets, the ratio is 13:11. We already know fixed asset value to be 26 lakh. So obviously the current asset will be 26 lakh into 11 by 13. 26 lakh into 11 by 13, which is 22 lakh. Current assets is 22 lakhs. So in a sense, we say the total of this, total of all the current assets should be 22 lakhs. So if current assets total is supposed to be 22 lakhs, obviously cash and bank balance, we can just get it as a balancing figure. That balancing figure will be essentially 22 lakh minus 3 lakh 31 500 minus 3 lakh 97 800 minus 12 lakh 82 192 1 lakh 88 508. This is 1 lakh 88 508 is the current asset. So essentially total asset is 48 lakhs. Now share capital reserves, long-term loan and current liability, we can say. For that, we'll use some more ratios. We have used fixed asset. Now current ratio is 2:1. Now That's really great. Now, since the current ratio is given, current ratio is specified as 2 is to 1, right? Current ratio is 2 is to 1. So therefore, current asset upon current liability is 2 is to 1. We've got the current asset value to be totaling to 22 lakhs. Current asset is 22 lakhs upon current liability of 2. The current liability will be 11 lakh. Current liability will be 11 lakhs. Then next is long-term loan to current liability is 2 is to 1. So since we have this ratio of long-term debt, long-term loan to current liabilities to be equal to 2 is to 1. So long-term debt with 2 into 11 lakh. Long-term debt is 2 into 11 lakh, 22 lakhs. Long-term debt is 22 lakhs. Okay. Long-term debt is 22 lakhs. Now, what is the other thing? Share capital to reserves and surplus is 1 is to 4. We know essentially the total of balance sheet should be 48 lakh itself. It means the total effect of share capital and reserves be 48 lakh minus 11 minus 22 is 15 lakh. Now this share capital and reserves, 15 lakh, we got this as a balancing figure. This needs to be distributed between uh, share capital and reserves and surplus in the ratio of 1 is to 4. Okay. So we'll say since share capital plus reserves is 15 lakh and this needs to be distributed amongst both in the ratio of 1 is to 4. 1 means we need to have 3 lakh and over here it is 12 lakhs. 3 lakh and 12 lakhs. So share capital is 3 lakh and reserves is 12 lakh. Share capital 3 lakh, reserves of 12 lakh. That completes our total balance sheet as such. Able to get it, guys? See if there are queries. Why is closing stock not considering profit and loss? You can consider closing stock, but again, since we have taken the raw material consumption, we don't have information about opening stock, right? Because if you're saying I need closing stock, I need to also write the opening stock. Opening stock information is not given. So we're just taking the net of raw material consumption figure. Okay, is it clear? Left net profit. No, net profit is there, 6,24,000. This 6,24,000 is a part of this 12 lakh. So after transferring of that profit over here, we have the reserves balance as. Is it clear, guys? How to solve a typical question? No, no such queries as such. I hope the flow was clear. Yes, clear? Fine. So let's take a break now. After the break, we'll take up maybe a couple of or three more questions for solving in today's class. Let's take a break of 10 minutes, guys. Quick. Okay. So welcome back after the break, guys. Let's go ahead with the next question. We have done question 3 right now. Um, let us take up uh, question number 4 as of now. Let's look at question number 4. We have a company which has the following details. We have sales figure, return on net worth. Then we have rate of income tax, share capital to reserves, current ratio, net profit to sales, inventory turnover based on the cost of goods sold. Then we have the cost of goods sold figure. We have interest on debentures, receivables, and payables. We have to compute the operating expenses for the year ended 31st March and also prepare the balance sheet as on that date in the following format. Okay, fine. So we have to calculate, our first objective is to calculate the operating expenses. Now to compute the operating expenses, we need to begin with the sales figure. It has furnished the following ratios and information relating to the year end. Sales is given. Now we have the return on net worth and we have rate of income tax. One important figure that we have is net profit to sales figure of 6.25%. Net profit to sales figure of 6.25%. So let us target that particular thing. Return on, not return, but net profit to sales. So we have net profit figure be 6.25% of 60 lakhs. And profit is 6.25% of 60 lakh, which is 3 lakh 75,000. The amount of net profit. Now to this, we will definitely, obviously this is our profit after tax. We will add the income tax on this so as to come at profit before tax. Adding income tax. Now what's the rate of income tax that given us 50%? Since rate of income tax is 50%, that's going to be exactly same as net profit because net profit will be after subtraction of this 50%. So profit before tax is 7 lakh 50,000. Now we're just going backward. So we'll just add interest. Adding interest, debenture interest, that's going to be debenture interest is essentially 50,000. That's already given. The number of debenture interest is already given. So just add it 3,000. That will give us a number of 8 lakh 10,000, which is profit before interest and tax. Profit before interest and tax. We have the sales figure. Sales is given as 60 lakhs, right? And COGS is also given. So let me take sales of 60 lakh. We'll consider COGS is cost of goods sold is 18 lakhs. So we have the GP, right? We have the GP figure, gross profit figure. Gross profit figure of 42 lakhs. Obviously, from this gross profit, you subtract your operating expenses and then you get your profit before interest and tax. So profit before interest and tax is 8 lakh 10,000. So essentially, our operating profit will be a balancing figure, so 42 lakh minus 8 lakh 10,000. Then we need 32 lakhs minus 8 lakh 10,000 is 33 lakh 90,000. So the first thing that was asked, operating expenses is that 33 lakh 90,000 is your operating expense, which is definitely the balance figure that we get from the extract of the PL. Okay. Now we have to go for filling up the balance sheet items. So let's have a look at the balance sheet picture numbers that we have. We have got the return on net worth. Return on net worth. Then we have share capital to reserve. So let's look at return on net worth first. Let's try to compute the number of return on net worth. Return on net worth is 25%. You know, this return on net worth is computed as profit after tax upon net worth is 0. You can say this is into 100 is 25. So profit after tax is something which we have computed right now. Profit after tax uh, was 3,75,000. Let's take the same profit after tax of 3,75,000 upon a net worth, which we are not aware. So we'll have to compute the net worth from this. Worth into 100 is 25. So what will be the amount of net worth, guys? So net worth will be 3,75,000 into 100 by 25. Net worth works out to be 3,70,000 into 100 divided by 25, which is net worth is 15 lakhs. Now, this net worth will be actually distributed between two items. One is the share capital and other is the reserves. So this 15 lakh needs to be distributed into two aspects. Share capital and reserves. Share capital and reserves, the ratio is 7:3. 7:3. So 15 divided by 10 into 7. So share capital will be 10 lakh 50,000 and reserves will be 4 lakh 50. Done. We are done with the share capital and reserves and surplus. Let's look at the other ratios. Current ratio is 2:1. For that, we'll need current liability, no information as of now. We'll see later. Net profit to sales is given. Then inventory turnover based on cost of goods sold. So definitely from here, we can get the value of inventory. Inventory turnover is 12. Now this inventory turnover is based on COGS. This will be COGS upon inventory is 12. So what is the value of COGS? COGS is 18 lakhs. 18 lakh divided by inventory is 12. Essentially, we get the value of inventory to be 18 lakh divided by 12, which is 1 lakh 50,000. We get the inventory or stock to be entered in our balance sheet to be 1 lakh 50,000. Okay, so inventory turnover is COGS is given, interest on debentures, payable and receivables are given already. Interest on debentures is 60,000, and there's a hidden part over here which says that interest rate is 15%. So interest on debentures and the rate can be used to compute the amount of debentures. Value of debentures is equal to The interest divided by interest rate. Now, debenture interest is 60,000 and interest rate that we have seen is 15%. Debenture amount will be 4 lakh. Now, so interest upon interest rate is 60,000 divided by 15%, which is 4 lakh. We're getting the value of debentures. So from the balance sheet, we have filled up with share capital, reserve surplus, debentures. Payables is given, receivables is also given, stock is what we have bought, and fixed assets. Also computed, right? The fixed assets, no. In look at current ratio, since payables is given, obviously there's no other current no, liability. You can simply say current ratio equal to current assets upon current liabilities. And this ratio, current asset to current liability, is given in the question. So we have current assets upon current liabilities of the payables amount, which is 2 lakh. Whatever is payable, that itself is the current asset. So we can say current assets is 4 lakh. Now we are good to go with the balance sheet to complete it fully. Okay, so we've got fixed assets. Then in the current assets, we have 3 items. And on the liability side, you have share capital. Then you have reserve. Then you have 15% debentures and payables. So share capital, we're going to say share capital is 10 lakh 50,000 is what we have computed, and reserve of 4 lakh 50,000 is also computed. Debenture of 4 lakh is also computed. Payables is given as 2 lakhs. Now, in the fixed assets, we haven't computed anything, but yes, in current assets, we are going to have the stock or the inventory. Then we will have the receivables, then the cash. Stock is stock inventory we have computed, right? Inventory was 1 lakh 50,000. And receivables is given in the question. Receivables is 2 lakh. Cash is yet to be computed, but we know the total of current assets. Total of current assets is 4 lakh. So obviously, we can get the cash balance as the balancing figure, which is 50,000. And one more thing is, since the assets should be equal to liabilities, the total of liability is 21 lakhs. Accordingly, fixed assets is going to be 17 lakhs as a balancing figure. Total comes out to 21 lakhs. That's the question, the solution to question number 4, guys. Is there any queries that I need to look at? How we got 15% from balance sheet, right? Whenever you're solving this question, this set of issue analysis questions, just keep a sight on the balance sheet, whatever is pending, or keep a sight on the P&L, whatever is pending. Try to get the numbers which are connected, or try to use the ratios which are connected. That way, it will be like just a puzzle solving, it's just unfolding on itself. Okay, debt calculation. Yeah, sure. Uh, in the question, they have given that the interest is 60,000. The interest is 60,000. Interest rate is given at 15%. This 60,000 is going to be 15% of the principal amount. And what is the principal amount? Will be 16, obviously 4 lakh. The 4 lakh multiplied by 15% should give you 60,000, right? So therefore, we are just dividing this 60,000 by 15, which is a normal 11th or 12th standard adjustment. We good to go. Important question. Someone is asking important questions. Important question. You're giving ICAI exam, dear. Cannot be asking important questions over here. You need to cover everything. Where you got 15%. Rohini, in the balance sheet itself, see 15% debentures. Stated 15% debentures. So from there we got the rates. It's a hidden part. I hope this makes sense to you. Yeah. Let's take up another question. Practice. Now this time let's prepare an outline and then try to solve it. Question number 10, guys. In question 10, from the following information and ratios, prepare balance sheet as of 31st March 2023 and income statement for the year ended on that date. Right. So we have an average stock of 10 lakhs. Remember, this is the average stock. This will be like opening plus closing divided by 2. We have been given a current ratio of 3:1, asset test ratio of 1:1, PBIT to PBT is 2.2:1, average collection period 330 days, 30 days, stock turnover using sales as a turnover, this is 5 times, fixed asset turnover is 0.8, working capital is 10 lakhs, net profit ratio is 10%, gross profit ratio is 40%. Operating expenses is given, long-term loan interest percentage is given, and tax is nil. So we have to prepare the balance sheet as well as the income statement from these numbers. Uh, so when we have these type of questions, always try to search for P-term values and the connected percentage or the ratio. P-term value we have one as the average stock. Then we have 10 lakh as working capital. Remember, this working capital will be current asset minus current liability. If you have anything connected with current asset and current liability, any ratio connected with current asset and current liability, yes, sir, current ratio we have. So from here, we can take a hint that we are going to connect current ratio and the working capital. From that, we'll be able to get the amount of current asset, current liability. Now, all these GP ratio, NP ratio are dependent on sales. We need to get the sales value first. Can anyone tell me how do we get the sales value? Because when we get sales, then only we'll be able to calculate the net profit and gross profit. Compute net profit and gross profit. I need the sales value. How do we get the sales over here? So for sales, we'll take help of average stock and stock turnover ratio. Because in stock turnover, they're saying you have to use sales as turnover. So I'm going to connect average stock and stock turnover to get the stock value, get the sales value. Now, let's begin the solution first by connecting current ratio and working capital. Then we'll look into the average stock and other aspects. First of all, current ratio. Current ratio is current asset upon current liabilities. Current asset upon current liabilities is 3:1. Now, current assets are basically something which we know information about current asset or current liabilities, right? No information about, do we have any individual value of current asset, current liability? No. So let's just try to connect both of them with the help of a simple equation. We'll say current asset is 3 times of current liability. Let's make it as question number 1. Then the question gives us information about working capital. And working capital, it is essentially current asset minus current liability. And the question gives us current assets or working capital is 10 lakh. Current asset minus current liability is given as 10 lakhs. And when we subtract that, this 3 current liability minus current liability is 10 lakh. 2 times of current liability is 10 lakh. Current liability is, let's say, 5 lakh. Right? So we got the current liability to be 5 lakh. Therefore, current asset will be 3 times of current liability. 3 into 5 lakh, which is 15 lakh, is the value of current asset. The current asset is 15 lakh. So we connected working capital and current ratio to arrive at these numbers. Then the question also gives us information about asset test ratio to be 1:1. Now, acid test ratio, we have already discussed what is acid test ratio. How do we compute that? Acid test ratio is current asset minus stock. Now, obviously, the question is silent about any amount of prepaid expenses. So we are just ignoring the prepaid expenses. We're saying acid test ratio will be current asset minus stock upon current liability, which is equal to current asset minus stock on current liability, and that ratio is 1:1. Current asset minus stock is 15 lakh minus stock on current liability is given as 1:1. And current liability is what we have already calculated, which is 5 lakh. 15 lakh minus stock upon 5 lakh is 1:1. We can say this is 15 lakh minus stock is 5 lakh 50,000. So the stock is 15 lakh minus 5 lakh 50,000. That should work out to be 9 lakh 50,000, right? Oh my God. So this should be stock. Since it is 1:1, this will be 5 lakh itself. So stock will be accordingly 10 lakh. We get the value of stock using acid test ratio. Now I think the connected 3 ratios, we have solved it: current ratio, acid test ratio, and the working capital. Now next is acid test ratio. We have PBIT to PBT. That is essentially for preparation of income statement. Let's focus first on the balance sheet, then we'll go to the income statement computation also. Average collection period, again, this is for the debtor calculation. For that, we will need the value of sales. For that, we will need the value of sales. Then we have stock turnover ratio. Again, yeah, we'll use the stock turnover as I've indicated at the start. We'll be using this stock turnover 5 times. for the average stock. Get the sale value from the average stock. So let us say stock turnover ratio. Stock turnover is 10 times and average stock is 10. Stock turnover is 10 times. No, stock turnover is 5 times. My bad. And how do we get the stock turnover? We get the stock turnover value as sales upon average stock as 5. Sales upon average stock is 5. So we get the sales upon average stock is 10 lakhs. Average stock is 10 lakhs and this is 5. So we can say sales value is 50 lakhs. Right? So we got the sale value. Now based on sales, we can actually get the debtor value by taking this as a 30 days criteria. So debtors will be credit sales into debtors collection period upon what is the number of days, or is it any specific given number of days that we have to use, that it is 365 or 360, specified anything of that sort? Doesn't seem to be right in the question. Yeah, it's not specified anywhere. So we'll take 365. So debtors collection period upon 365. Credit sales will be we have computer. We'll say that all sales are on credit basis. That will be the valid assumption that we can make. Sales is 50 lakh into debtors collection period of 30 upon 360. This number is 50 lakhs into 30 divided by 360, 4,16,667. That's the value of debtors. So we have got reduce the average collection period also, working capital is also done. Fixed asset turnover is given over here. The fixed asset turnover, from this we can get the value of fixed assets. Let's use the fixed asset turnover ratio. Fixed assets turnover is 0.8. When I say 0.8, it will be sales upon fixed assets. So we'll say 0.8 is equal to sales is 50 lakh, 1.8 on fixed assets. Fixed assets will be 50 lakh divided by 0.8. 50 lakh divided by 0.8, which is 62 lakh 50,000. Fixed asset is 50 lakhs divided by 0.8, which is 62 lakh 50,000. So if we just visualize, we are done with fixed asset. We're done with the value of the debtors. Yeah. Debtors is done. Stock is done. Maybe just cash balance spending. And on the liability front, we have current liability available. Maybe some equity or debenture data we need to check. So here we have net profit ratio. There's long-term interest rate is given. From that long-term interest, we will be able to compute the amount of borrowings also. Now we need to actually work on the P&L part. Let's try to prepare the P&L part. We have the sales figure. Sales figure is 50 lakhs, right? Okay. Now sales figure is 50 lakh. From that, we need to subtract the COGS, cost of goods sold. Do we have any information about cost of goods sold? Yes, because we have a net profit of 40%. We have a net profit ratio of 40%. So since, sorry, on gross profit ratio of 40%, gross profit ratio is 40%. Now this 40% will be definitely gross profit upon sales, which is 0.4 is equal to gross profit upon 50 lakhs. So gross profit will be 50 lakhs into 0.5, so 0.4. 50 lakh into 0.4, which is 20 lakhs. So gross profit is 20 lakhs. If your gross profit is 20 lakh, of course, your COGS, cost of goods sold, will be 50 lakh minus the gross profit of 20 lakh, which should be 30 lakhs. So from sales, we will subtract COGS 30 lakh, which will give you a gross profit of 20 lakhs. Now, from this gross profit, we need to subtract other operating expenses also, which is given in the question. Operating expense excluding interest is 9 lakhs. Right? So let us subtract that. Less operating expenses 9 lakh. This will give you profit before interest and tax, which is 11 lakh. Now we have a ratio over here. PBIT to PBT, which is profit before interest and tax to PBT, is 2.2:1. So profit before interest and tax upon profit before tax is 2.2. We can say since PBIT is 11 lakh upon a PBT of 0.2, means PBT will be 11 lakh divided by 2.2. PBT will be 11 lakh divided by 2.2, which translates to 5 lakh. So, of course, if your PBT is 5 lakh, you can definitely say the interest component, interest will be profit before interest and tax minus profit before tax. Profit before interest and tax is 11 lakh minus PBT of 5 lakh. Interest works out to be 6 lakh, right? We subtract from here the interest of 6 lakh and the profit before tax is 5 lakh. Now, do we have any tax rates given over here? Tax rate is nil. So this itself is your profit after tax or the net profit. Now, since we have got the interest to be 6 lakh and the question says that long-term interest rate is 12%. How do we get the long-term debt amount? Long-term debt is simply debt amount into rate of interest. Or we can say it is simply interest on debt is debt amount multiplied by rate of interest. Interest on debt, we have it as 6 lakh. Interest on debt is 6 lakh. We don't know what is the debt amount. into, but the rate of interest is given as 12%. So since rate of interest is 12%, amount of debt will be 6 lakh divided by 12%. 6 lakh divided by 12% is 50 lakh is the amount of 50 lakh is the amount of debt. Now let's prepare the balance sheet and try to fill up the maximum values, whatever is available, and then see if there are any balancing figures to be obtained. We need to have fixed assets. We need to have look at the fixed assets. Now, what will be the amount of fixed assets? Did we compute the fixed asset? Yes, 62 lakh 50,000 is the amount of the fixed asset. 62 lakh 50,000, the amount of the fixed asset. Then what about current asset? Do we have the value of stock? Yes, we have the value of stock as well as debtors and current assets in total. Fixed assets, after fixed assets, we'll take up current assets. Now in current assets, we have stock, we have receivables or debtors, and we may have some amount of cash balance also. Generally, you will have cash itself to be the balancing figure. Stock was 10 lakh, right? We have computed that. Stock was 10 lakh. Debtors is 4 lakh 16,667. And also, we have stated that total current assets is 15 lakh and current liability is 5 lakh. Current assets totaling is 15 lakhs. It means the balancing 83,333. 4 lakh 16,667. 83,333 was cash balance. Right? Yeah. Now coming to the liability side, we have the current liability. Current liability, we have computed it as 5 lakh. Long-term debt is what we have computed just now as 50 lakhs. And then we have the equity, which is a combination of share capital and reserves. And this is going to be the balancing figure. The balance sheet tallies at 77 lakh 50,000. This side it is 77 lakh 50,000. Now equity is 22 lakh 50. Okay. Here we complete this balance sheet also. Let me see if there's any queries. Cost of sales, how is it sales? Cost of sales and sales are totally different. Is it given? We divide by 360 days for better. 1 second. Yeah, so this is 360, correct? Assume 360 was given. Net profit. What is works cost? Works cost is basically your cost of goods sold, which includes your manufacturing expenses also. If the question is silent, you should take 365 as we have done in the last question. But here, since the question specified it to be 360 days, we have taken the same. Good guys. I hope this type of questions you'll be able to solve. Just need to connect the ratio and the numbers. We have question 10. Okay, fine. So question 10 is good to go. Now, let us look at some other type of B. There are questions, wherein you need to compute the ratios, which are pretty simple. Uh, but let me just test you on some different line. Let me just test you on some different line. Let me ask you a few questions. First is, let's say, current ratio is 2 is to 1. Okay, so originally, current ratio we are saying it is 2 is to 1. Now, suppose uh, cash deposited into bank, cash is deposited to bank. Tell me what will happen to the current ratio. Current ratio will increase, decrease, or is it going to remain same? Answer me, guys. If your current ratio is, let's say, 2 is to 1, if current ratio is 2 is to 1, and you deposit some cash to the bank, you had some amount of cash in your drawer and you just take it and deposit it to a bank. So what's going to happen to your current ratio? Is the current ratio going to increase, decrease, or is it going to remain same? Yeah, guys. Current ratio will, in this case, it will remain same, guys. It won't change because when you deposit cash to bank, your current asset remains same, right? Your cash will get reduced, your bank balance will increase. So in essence, in essence, what you will have as in total assets, total current assets, that will remain same. It's just uh, the form is changing, right? Because when you're depositing cash, your cash reduces and your bank balance increases. The total current assets remain same, it will remain same itself, no change. Now, second criteria, second one, let's say uh, amount collected from debtors. There was some amount outstanding and you are collecting the amount from the debtors. There was some outstanding amount from the debtors and you're collecting it now. So what will be the impact on current ratio? Tell me, will the current ratio increase, decrease, or is it going to remain same? Tell me this. You're collecting some amount from the debtors. What will happen to your current ratio? What will happen to your current ratio? Is it going to increase, decrease, or is it going to remain same? It is decrease, remain same. Well, over here also, current ratio will remain same because when you're collecting money from the debtors value will decrease and your bank or cash balance will increase. The net impact is no change in current assets. and therefore your current ratio will remain same. Third question, payment to creditor. If you make payment to your creditor, what will happen? Current ratio will increase, decrease, or is it going to remain same? You're making payment to your creditor. Some amount was outstanding, and you're making payment to the creditor. So what do you feel? The current ratio is going to increase, decrease, or is it going to remain same? Tell me guys, what's going to happen to the creditor if you make payment to the creditor? What will be the situation for the current ratio? Same, decrease. Okay, let's have a look at it with the help of numbers. Uh, Now, of course, if you're making payment to creditor, the balance of creditors will go down, and also current assets balance will go down, right? So, if your old current ratio was, let's say, X, the new current ratio will be X minus Y upon Y, minus Y upon 1 minus Y, right? Or let me just help you with the numbers. Let's say old current ratio or old current asset was 5 lakh and current liability was 2 lakh 50,000. So your original current ratio is 2 is to 1. Now new current asset will be, let's say you made a payment of 50,000 to the creditors. The new asset will be 4 lakh 50,000. Current liability will be 2 lakh. So current ratio will be 4 lakh 50,000 divided by 2 lakh. 4 lakh 50,000 divided by 2 lakh. This works out to be 2 point. If you consider any amount, let's say 50,000 paid, if you take, let's say 1 lakh is paid, then this becomes 4 lakh and this becomes 1 lakh 50,000. Now the ratio is 4 lakh divided by 1 lakh 50,000, which is 2.666. So if the greater the amount of payment happening, the current ratio is in improvement situation. Current ratio is in the improving situation. Okay. Now, let's say fourth scenario, payment of interest on long term loan. Payment of interest on long term loan. Tell me. Meanwhile, Praveer Datta is asking how your second answer is remaining same because you collected an amount from debtor, Praveer. So you are no more having the debtor balance as it was earlier. So debtor balance gets reduces and bank or cash balance increases. So essentially no change in the current asset, therefore current ratio remains same. Now this one, fourth one guys. If you have a payment of interest on long-term loan, what will be the impact of this payment of interest? Whether the current ratio increase, decrease, or is it going to remain same? Payment of interest on long-term loan. Yeah, it is long term. So of course, payment of interest on long term loan, current ratio, is it going to increase, decrease? Of course, the current ratio will decrease because when you're making payment of interest, your cash or bank balance goes down. Cash or bank balance goes down, and that actually causes the reduction in the current liability. That causes the reduction in the current asset, and even the current ratio will decrease. Right? Okay. One important aspect over here when you are making payment to creditor, we took the current ratio as 2:1. If we take, let's say, current ratio of no, let's say 1:2, then in that case, let's say if it is 1 lakh and if it is 2 lakh, now after payment of 50,000, this will be 50,000 and 1 lakh 50,000. Current ratio is like, it's becoming 1.3. Current ratio is becoming 1 point, sorry, not 1.3, becoming 1:3. So if your ratio is lesser than 1, it is generally going to decline. But in real life, we say that negative current ratio couldn't be there in any company because if that's the situation. It's a quite risky situation. So therefore, we generalize it into current ratio greater than 1. Okay, then let's look at this case 5. Okay, case 5. Uh, Cash sales. When you do cash sales, tell me, is your current ratio going to increase, decrease, or is it going to remain same? When it is cash sales, what do you say? Is the current ratio going to increase, decrease, or is it going to remain same? When you have cash sales, if you're undertaking cash sales, what will be the impact on the current ratio? Increase, decrease, or same? Well, over here, the answer will be same, guys, because when you have cash sales, your cash balance will increase, but stock balance will decrease, right? Because you need to remove the inventory from the balance sheet once it is sold. Cash balance will increase and stock balance will decrease. So ideally, it should be remaining same, or if it is sold at cost, because here you need to check if goods sold for profit, goods are sold for profit. Obviously, cash will be greater than inventory cost. So essentially, if you assume that goods are sold for profit, so incoming cash will have a higher value as compared to the outgoing stock. In that situation, increase. If the goods are sold for loss, then it will be decrease. If the goods are sold at cost, then it will remain same. So if it is sold for profit, then it is increase. If it is sold for loss, then there's a decrease. And if it is sold for same, at cost, then it will remain. Okay, fine. Uh, Let us look at a question. Loan taken as long-term debt. Tell me, what will be the impact on current ratio? Will it increase, decrease, or is it going to remain same? Long-term debt. If loan is taken as long-term debt, then tell me whether the current ratio will increase, decrease, or is it going to remain same? Yeah. Loan taken as long-term debt. Over here, obviously, if you've taken the long-term debt, cash balance will increase. Your current liability remains same. So net impact will be current ratio will increase. Clear? Okay. Now, let us say next case, bill discounted, dishonored. What will happen to the current ratio? Bill discounted is dishonored. What will happen to the current ratio? Will it increase, decrease, or is it going to remain same? Bill which was discounted, it has now been dishonored. Bill which was discounted earlier, now it has been dishonored. So what will be the impact on the current ratio? Taipa Virali is asking me when we take a loan, liability also increases. Liability increases, but it's a long-term debt. So it's a long-term debt. So if it's a long-term debt, that doesn't come into the current ratio. Current liability, it's not current ratio, right? Current liability is, I mean, long-term debt is not a current liability. So that's not considered over here. Yeah, bill discounted, dishonored. What will be the impact on current ratio? Well, bill discounted, dishonored will ensure that your current ratio remains same because as the bill discounted gets dishonored, bank will deduct my bank balance, and on the other side, I will have a debtor in my books. So this will lead to reduction in bank balance and increase in debtors, and therefore that will remain same. Okay, perfect. So I hope you have got a hold over the current ratios now and other things that we have done. Any other queries, guys, that we need to look at? Was done with my part as of now. Uh, we'll have one more session on ratio on which I'll be putting a practice. After today's session, I'll be putting a practice session questions for you. You're required to solve the same, and maybe the solutions for them will discuss it in the subsequent lecture of the revision class. As of now, if are there any queries that we need to really look at? We just have a look at it if there are any queries, or else we can just call it a day. Okay, no, very same. Okay, you have answered the questions. Question 5, Sahil is asking. Question 5. Question 5, Sahil, just remind me to solve this in the revision class. I'll do it for you. How to overcome? I feel stuck in between. So whenever you're stuck, you just look for the connecting ratio and the numbers. Always start the question with as far as possible, whatever is available. By looking at the rupee values and the ratios, and prepare a draft balance sheet and P&L. So you'll get to know where to fill the balance things. Question 5. Please explain. Okay, when you have cash sales, if you're making the sales for a profit, now the cash that will be incoming will be a greater value as compared to the value of inventory. So of course, cash balance will be more, increasing by a more amount than the reduction in the inventory. So current ratio will increase. Similar thing applies for even when you're selling for loss or when you're selling at cost. Okay, so I think that is done. Yeah, so we are good to stop for the day. Let's stop here for the day, guys. See you in the next class with another topic. Post that, we'll have a revision session for the both the topics. Till then, the best. Keep studying. Meet up in the next class. Bye bye. Enjoy, guys. Good night.